Thank you, everyone. We are sort of 45 folks and rising as we come into our webinar. So first of all, I just want to say thank you guys so much for coming and joining. We hope you'll get a lot of value out of this in our term sheets in a recessionary environment. Just to do a handful of introductions so you know who is speaking right now and who are the two actual experts who are going to be answering the questions that we have on term sheets in a recessionary environment. I'll get to that. But first of all, I just want to, we should be able to leave some time at the end for Q&A from those participants. So as you think of questions that you may want answered, feel free to put them in the Q&A section and we will try to get to them as we go through the panel. I am Craig Wilson, the Managing Director at the Data Future Lab for the NYU Tandon Future Labs. We are an incubator program that is in partnership with New York City and State and Orrick. And our whole goal is to promote technology and entrepreneurship in New York City and State and have a resource share with NYU Tandon, our other partners, and everything that we do is in support of entrepreneurs. So this is why we're doing things like this. We understand that it is a unprecedented and extraordinary time, and so we're trying to do as many things as possible to help answer some questions. Our two panelists are both from law firm Orrick, Harrington, and Sutcliffe. I think I got the three names correct, but I'm sure Pete or Geoff will correct me if not. So first of all, Pete Fusco is a partner in the technology companies group based here in New York. He is also the head of the New York technology companies practice and has over 2 decades of experience working with early stage companies, helping them with financings, whether it be angel rounds, venture capital, private equity, or growth, and has been through now 3 downturns, I think, is what we were discussing yesterday. And our other panelist is Geoff Willard, who is a partner in the Washington, D.C. office of Orrick, and he likewise has over 2 decades of experience also acting as a strategic advisor to companies and investors and has seen many downturns as well. So we have 2 people who have expertise not only in institutional financings, but also have experience in seeing downturns and understand what these look like and how we might anticipate financings to change, how term sheets could change, how you can expect to go about raising money as an early stage company in an unprecedented time. So before we really get moving, first of all, I will just give a general overview of some of the things that we've covered in our past webinars, and then have Pete and Geoff comment on that, which is, we have seen a lot of companies that are looking to raise financing. They ask how much runway they should actually have, and what we've seen, at least from the Future Labs, from talking with our advisors from investors, is that 18 months of runway is roughly what companies are looking to get. Now, obviously, that isn't, that's only feasible based on your personal company circumstances. So, I think it is as much as you can get. And secondly, as a disclaimer, as you look to raise institutional financing, make sure you do your diligence on your investors as well. Some people are investing, some people are not investing. Everyone is saying that they're investing. So make sure you ask around and do as much diligence on your potential investors as they're going to do on you. Anything to add in particular as what you guys have been seeing just in general, as far as like what companies are doing to prepare for the next 6, 12, 18 months, and what kind of advice you might give there, and then we'll dig a little bit more deeply into term sheets and the sort of more of the minutia of financing.
Yeah. So I think is at a high level, the way I would look at this is so back in 2008, when we went through a downturn there. I don't know how many people were doing this back then, or had companies, but at the time, Sequoia, which is a pretty large venture fund, I'm sure everybody's familiar with, had sent out this release that said "R.I.P. Good Times" and had a tombstone on it. And the view then, which is kind of the view now, is that people should be trying to secure funding, as you said, to make it through the next 18 months. And, then as now, the feeling was if you have, if companies can avail themselves to existing investor bridges, or if they have the ability to do debt rounds. Many people did debt rounds back then, look to their banks like SVB and others to get non-dilutive funding to get through this period. So I think at a high level, and then Geoff, you could whatever you want to add, but I think at a high level, the idea was kind of hunker down, raise what you can now, and figure out a path to the next 18 months to try to get, to try to kind of weather the storm and get going again once things get more back to normal.
Mm-hmm.
Yeah, I mean, I think that's right. I think we're going to be in a challenging environment, as everybody knows, for a while. And it is going to be different raising money today or in 6 months, maybe even a year from now than it has been. But, the good news is the venture funds, the big ones, have been through this before. And a lot of the partners at smaller funds and at seed funds and angel funds, they've been through this before. So I think that we will have an adjustment period, but things will get back to normal. And I think, we had done some looking for some other internal things we were doing. If some companies that you all know, like WhatsApp, Instagram, Pinterest, Airbnb, all of those companies and many others were founded in 2008, 2009. So what we're going to find is that there are going to be people at big companies who get laid off. And, really, honestly, in New York, the layoffs in 2008, 2009 fueled like a huge amount of the fintech, insurtech, prop tech, you name it, businesses, because folks didn't really have a place to go to a big company or an investment bank or a bank, and they started grouping together and doing founding startups. And the hedge funds, who traditionally did not invest in startups, started sprinkling money, and that's really what fueled the community that, Craig, that you have built up around NYU and throughout New York. So I think good things will ultimately happen, but it will be a more challenging funding environment. It's just, it's the nature of the beast.
Yeah, I think that makes a lot of sense. And it's interesting to your point, Geoff, about, I think, it's sometimes it's difficult to look beyond 6 inches in front of your face in an extraordinary time like this, but these sorts of downturns really help people develop habits and practices within their company that allow them to, really be creative, lean, and survive. And that is proven out in data as well, that many of our greatest companies, and in fact, best performing, venture funds, are invested throughout downturns, which is an important thing, I think, for all of our attendees to sort of understand and know that those, Pete, would you say that it's, would you say that those, Pete and Geoff, would you say that those venture funds that have invested throughout downturns in the past know this to be true and are therefore more likely to be investing throughout this downturn versus newer funds that have not yet seen something like this?
So I think it depends. I know funds that have, we've heard a number of things from a number of different folks. But typically most funds, when this starts, will kind of take stock of their portfolios and figure out what those, what their current companies are going to need in order to get through everything. And for a period of time, usually the focus is on them a little bit to figure out path forward and what needs to be done. But but what you have to remember is when a fund closes a fund, it has to deploy. So, you know, a lot of funds will deploy over a 3 to 5 year period, collect on the back end, and work on launching another fund. So even if you have folks who sit out a part of the year to kind of curate their portfolios, make sure the bets they've placed are safe, and can make it through. Ultimately, I think you'll see funds redeploying in, you know, at least towards the end of the year, solely because, you know, they have to use the money. And a number of funds that we spoke to have said that they are presently doing deals, and, you know, in terms of, and not just saying it, but explaining that they have several term sheets that they recently signed or deals that they have ongoing. So I think it depends on the fund, but I would expect people have to continue to deploy, because that's the basis of the business, is deploying, collecting, and you know, launching a new fund on the back end of performance.
Yeah. Geoff, anything in particular to add to that before we dig into the actual minutia of term sheets?
Yeah, I think you guys covered it. I think, you know, and funds will have different life cycles. So some will be more active and some will have more triage in their existing portfolio. But I think at the end of the day, people are going to keep investing because, as Pete said, it is the model. They have to keep investing. And, you know, candidly, the valuation environment is more attractive today than it was 3 months ago. And we're seeing that already in deals where, you know, things have been repriced because investors have a little bit of uncertainty about whether they're overpaying. And yet, candidly, valuations were at a high point, right, within the last, you know, 12 months. So I think the reduction of valuations is not great for founders from the perspective of ownership of the company, but it actually can help get deals done that, you know, otherwise might not get done. So I think we'll see a mix of activity, and some, you know, some investors will be more active than others in the next 3 to 6 months, and then some others will pick up the slack. And, you know, as always, we will see new funds being formed. We will see new sort of angels and angel groups and seed funds coming together. So it will take a little while for this to become more steady state, but I have full confidence that investors are going to keep investing.
Yeah, that makes a lot of sense. And I might, before we go into it, there's kind of 2 questions in our Q&A that are relatively, you know, unique to this particular thing. So I might just ask them now, so we don't have to come back to it without any context. Which is, do we think funds are going to focus on, you know, the question is, quote, regreening their winners, which I believe means sort of, you know, doubling down on their internal portfolio that they believe are going to be successful. And then the second follow-up really quickly is, how does the have to deploy model differ for large funds versus micros or angels? Like, are later stage funds or angel funds able to be more patient throughout these at least initial stages of a downturn?
So, Geoff, do you want to take that, and I'll jump in?
Sure. And I think, Craig, I got distracted because I pulled up the Q&A, so I see 3 questions. So yeah. So I don't know if you're first. Yeah, I don't know if you're focused on the regreening winners or how angels and VCs, but I think those are kind of similar. I think we are seeing right now, a lot of funds are focused on their existing portfolio. So they are trying to triage those companies, make sure that they have sufficient capital, and make sure that they are kind of shored up for, you know, the relative near term, so that they don't have to worry about, you know, some of their companies running out of cash and hitting the wall. And so we're seeing a fair amount of that. I think, you know, I think most investors are reluctant to say it, but the reality is investors are in this to make money, and they are taking, they're doing what the VCs would call portfolio reviews. And they're taking a hard look at every company, and they're looking at it with a fresh lens and saying, is this a company that we think can make it through this challenging environment or not? And if they're on the or not stage, how do we, you know, what do we do? And I think at the end of the day, they are, unfortunately, investors have limited capital themselves. So they do have to, at some level, you know, quote, pick winners, because they've got to figure out which ones are worth plowing more cash into. So I think we'll continue to see that happening. And then as as things sort out, they may conclude, okay, someone who we thought was a winner is not going to be, or someone that we thought was going to struggle actually has done something, pivoted, which is a big term you'll hear a lot. They pivoted and switched what they were doing and now have a sustainable and growing business again. So I think we'll see activity change there. But at the end of the day, I think on the risk question, investors are they are going to have a tougher scorecard for their companies. They're going to look at things more critically than they did in a market where they could count on a new round coming together easily. And so the bar is definitely higher even for existing portfolios. And for new companies, I think you'll see companies that before maybe would have raised a $3 million seed round. Maybe they're raising $1 million now because the investors, whether they're seed funds or angels, want to see if the company can really make it work with their capital and are okay with a less fast growth environment, but one where they're building and seeing tangible milestones before they have to write more checks. So I sort of answered maybe two of those questions, but Pete, do you have anything to add on those or any?
Yeah, just as you were talking about that, a couple of things occurred to me. I think the first time I heard the word pivot was in 2008 and 2009. And when people started pivoting and changing their businesses. So I think it's something to remember that now's a time of kind of, as a founder, reviewing your own company and thinking about where it's headed and what else you could be doing kind of creatively to possibly adjust what your business plan is or what your kind of plan of attack is for the market you're looking at. The other thing is with respect to so years ago, a Series C deal, used to be tiny, and an A deal used to be like 2 or 3 million, and you go from there. And then I guess over the last decade, now we have people, we've had people doing A deals that are 15 million, C deals that are 5 million, and I think, as Geoff was saying, I think you're going to feel a scale back in those things. And I think the rounds that are raised are probably going to be at lower valuations and less money. And I think it's something that you just, when you are talking to your potential investors, it's just something to bear in mind that some of the metrics that we've seen in the past, I think, are going to scale back a bit.
A quick follow-up to that is, do you anticipate that, and have you seen in the last 2 downturns, and do you anticipate in this one, there's a lot of talk of, prioritizing profitability versus growth. Do you think have you seen in the last 2 downturns that investors were prioritizing profitability over growth then, and if so, and if not, do you anticipate that to be the case this time? I feel like it's something that is always being talked about as, growth is great when there's a ton of cheap capital available, but as you go into a downturn, investors are looking more for companies that can stay profitable and use sort of a little bit sounder, I don't want to say sounder business practices, but sort of more prudent financial practices to move forward.
So I think it depends on the stage of the business, right? I think if you are doing your seed round, I think it's still, you're still kind of what I like to call the dream stage. Mm-hmm. And that people are investing in the team and people are investing in what they think the ultimate outlook of the business will be. Mm-hmm. But I don't think there's a view as to profitability at that early stage. I think it's still focused on achieving what the company wants to achieve in growth and getting out there in the market. I do think there'll probably be a little more focus on what that means, because whereas, in the last decade, you could fund a seed company with the expectation that, this is all about growth. Don't worry about it. We're going to line up the A round that should come together. And there was just these layering of rounds in a natural succession of the company because times were so good. I think, an early stage company is still going to be viewed as a growth opportunity. But I think what that means and how long it takes to get that growth to profitability is going to come into the mix and be re-examined. I do think there'll be probably a lot more focus on numbers. It used to be that when you got to the B, then it was all about your numbers. And people would really drill down in the business side diligence to prove out that component of it. I think you may see a little more focus even at the early stage on growth plans to make sure that the growth plans can actually get there, because the succession of follow-ons that most people just kind of took for granted, I don't think will be there, in the next 6 to 12 months as readily as they have been.
Yeah, I think that makes a lot of sense. Okay, so we'll go into now actual term sheets and what to expect. So I think what we'll assume here is that there is some level of basic understanding of some of the terms in a term sheet, but if there's anything that I think we're kind of glossing over, I may ask you guys just to hold and sort of define something a little bit more deeply. But I think if folks are signing up, we're assuming that there's some level of understanding and folks are thinking about their fundraise in the near future. So to start, I think what I would ask is, first of all, is when you're advising a company who's looking at a term sheet, how should they go about looking through that term sheet? What are the sorts of things that they should be flagging, and how should they read through it? I mean, obviously, I think you might say, give it to, make sure to have your lawyer review it, preferably
send it
Orrick.
over.
Yeah, send it over to Orrick. But, as the entrepreneur looks through their term sheet, how should they go about reading it, and what are the types of things that they should look for?
Sure. So when Geoff and I were talking about this over the course of the last week or two, what we figured makes sense is, so first and foremost, right, is your valuation. Once you're there on the economics, then the structure falls into place. And for folks who are familiar or have been doing deals over the last 10 years, there's a lot of things that have become, almost common practice and not even thought about. Dividends, liquidation preference, anti-dilution protections, things that just have become customary norms that in times like this, historically, back in 2000 and 2008, there's certain pieces of this that are going to probably change as investors, look to take positions that protect them economically. And that's just kind of the way these terms will migrate. But what you want to make sure of, look, the majority of investors are rowing the boat in the same direction as you, and are doing the deal in good faith, looking to support and build the company. However, sometimes there are folks who are a little more aggressive in times like these. So I think what we'll do is we'll just work our way through the few things in the term sheet that you're probably going to see change, and then talk to you about how you should think about them, and when a red flag should go up on some of these, if that makes sense, is a baseline.
Yeah.
Great. So, Geoff, do you want to start talking about dividends, and then I could do liquidation preference, and we can just kind of alternate through them, if that makes sense?
Yeah, sure.
Really
so, yeah, that works. So dividends, candidly, for the last decade, dividends have been what I would call a throwaway term, in that most deals, they always have a line item that says dividends, but it says that the dividends will basically be payable when, as, and if declared by the board. And the key terms are when, as, and if. And the reality is that for a lot of reasons, some of which are legal and some of which are practical, boards very rarely declare a dividend because basically it's taking money from someone else and reallocating sort of proceeds in the deal. And so the practical reality is that in most deals, dividends are never declared and therefore never paid. And that, dividends, for those who are familiar with the term liquidation preference, dividends can be added to a liquidation preference, which is the amount of money that the VCs or the angels or seed funds get on their return. But again, they still have to, in the typical term sheet in the last 10 years, they have to be declared by the board. And in almost all cases, the board never declares the dividends. The difference that we're going to see now is that we're going to go back to what we saw a lot of in 2008 through probably 2011, or for those who were around then, in 2001 to 2002 or 3, when the dot-com bubble burst and then 9/11 happened, which is really the prior really big downturn. You're going to see something called accruing dividends, and the language is going to change. I mean, you might see accruing dividends today, but it doesn't really matter because they're never declared, and so they're just not practically something that gets paid out. But you're going to see the language change from when, as and if declared by the board, to whether or not declared by the board. And so there's going to be this pile of dividends that starts to accumulate in the background. And as a founder, you're probably not going to be aware of it. But an example would be if you did a $10 million round and the investors have an 8% dividend, which is pretty typical in these types of situations, you're going to find out that that's $800,000 per year, right, accruing. And so if you go out 5 years, you now have $4 million of dividends that augment the return of the investor and get paid out ahead of the common. So that's definitely going to be coming back, and we're already seeing this term pop up in term sheets. And it does have it really does shift it has the potential to shift the economics if the dollars raised are big and or the time frame between raising a round and getting to an exit is long. The longer it goes, the more these things build up. And then I'll turn it back to Pete. The other feature that you're going to see is that the word compounding, which many of you are familiar with from like bank interest, would not show up typically in these term sheets. That's going to show up again. So in my simple example, I didn't run the math, but the $4 million of dividends, it's probably going to be more like $5 million of dividends when you add in the compounding, or actually a lot more. So this will have a real impact. But the reality is what investors are trying to do is, in an uncertain market, they're trying to lock in some minimum level of return. And this is one of the ways that you can get there. So even though none of us really want to see this stuff come back, it's going to come back because the investors are trying to figure out how they justify to their own investors. And that's something that I think people lose sight of a lot, that venture funds and seed funds and angel funds, they have their own partners who they owe money to. And so they've got to justify to them why they're doing deals, and why you're hearing some funds are doing deals with accruing compounding dividends and they're not doing that. So there's a broader dynamic that comes into play. But Pete, any other thoughts on that, or Craig?
I think I think that's right, and I think that kind of talks about the direction things are heading. The only thing I'd mention is if you see the word compounding, now I'll say it, Craig, definitely reach out to your counsel, because compounding, when I talk about liquidation preference next, compounding can create real issues because it accelerates the accrual that you're building up.
Don't they say compound interest is the eighth wonder of the world or something like that?
Maybe. So anyhow, so dividends, most people gloss over in the term sheet. Don't make sure you're paying attention to it when it comes across. And the only other thing I'd add is make sure and I know I say this all the time, Craig, and you bust my chops about it, but make sure you talk to your counsel, because so many times people will do these term sheets and will think, oh, this is typical, this is fine, let's just sign it up and then I'll get the lawyers involved. If there's stuff like compounding or things that are, can be a little slightly oppressive, or other things that we're going to talk about, and you sign a term sheet up, it's harder for us to go back and get it back. So, when you're talking about when should I get counsel involved, as soon as the term sheet pops up into your email, you should have your counsel involved and you should have them looking at it, because there's nuanced things that if you don't catch and think it's typical and just sign it up to get it out of the way, they're going to be detrimental to you on the back end, and it's going to be harder for us to negotiate those out, if at all.
Yeah. The only thing I would quickly add to that, and is just a general piece of advice that I would give, that I give to all of my companies, and I'll add it so it seems at least like an independent piece of advice, is that Pete and Geoff are right in that you should look to your counsel to review these types of things and help you to understand what is normal, what is not normal, and what everything means. There's two main reasons for that. One is that your lawyer is on your side, and you are, they are your counsel. You pay them to be your counsel. And so they want what's best for you because they want your company to be successful, exist in the long term, and they want to continue to have that relationship with you. And the second reason is because your lawyer, particularly if you have someone like Pete and Geoff, sees more financings than anyone in this ecosystem. They see more than venture capitalists. They see more than founders. So they will have a much better idea of what these types of term sheets look like. And when they say something looks irregular, they are much more likely, that is more likely to be true than with anyone else. So that quick PSA there before we dig into liquidation preferences, et cetera.
Great. So liquidation preference. This is kind of part and parcel of what preferred stock is in its essence. And for those of you not familiar, over the past probably 10 years, liquidation preference has, for the most part, been non-participating preferred stock. What that simply means is if I put $1 million into your, I'm going to do high level math since I went to law school, not business school. But if I put $1 million into your company in your series seed and the company's valued at 10 million, it means when you sell the company, I get the better of my million back or the percentage interest I hold in the company. So take the example of I have 10%, I put $1 million in and you sell the company for $8 million. In that scenario, I'm going to take my $1 million back, my preference, which protects the hard capital that I put into the company. But now if you sell the company for 50 million, I'm going to take my 10%. So I'll take my 5 million. There's a transition there from the valuation of the company where my downside protection shifts to percentage interest, so I get the upside. So in times like these, we start to see something called participating preferred. And in some respects, it almost, we used to joke about it being an exit tax because what it does is now, if I'm the person who put $1 million into your company and I have participating preferred, what that means now is I get my $1 million off the top to start. And then I get 10% on a dollar for dollar basis. So when you see participating preferreds start to come into the construct of your deal, you have to think about that. Maybe it's not such a big deal if you're doing a $500,000 seed round or $1 million seed round. But if you're doing a $10-15 million Series A round, now what you have to think about is, okay, that money, when I sell the company, comes right out. So we reduce everything by the 10 or 15, the preferred gets paid back, and now we all share. And if you do simple math on that, you'll see kind of how it works out. And what can happen, so I'll give you an example. Back in 2000, I'll never forget this because I never saw it since. I had a fund that did a $10 million deal into a company. This was, I think it was May of 2000. And they had 5 times participating preferred. I've never seen that since. But what it means is when the company sold, they got 50 million off the top and then took their percentage interest. So when you start to take these, a participation right, and if there's multiples on it and you wrap in compounding or accruing dividends that accrue every year, you can start to see how it's almost like, it can become like if you had a house and your mortgage doubles and you didn't really think about it. You can get yourself into a situation where the amount piling up behind you on the exit can make your exit goals, or at least your initial exit goals, less meaningful, and you may have to recalculate where you need to get after you take funds. Geoff, do you have anything else you want to jump in on or add on that?
I think you largely covered it. But I do think the multiple liquidation preference that you mentioned, that's going to come back, and again, it's a way for the investors to juice their return. I think, Pete, I might have missed it, but I think one spin on that is what's called capped participating preferred. So sometimes you will see preferred that says we get a 3x return, guaranteed, or we get fully participating preferred stock guaranteed. And then if we get a minimum amount of return as an investor, then this participation right goes away or is capped out. And so it forces them to convert to common, which then becomes more like what most folks are used to seeing over the last 10 years, which is non-participating preferred. So in that case, the liquidation preference, as Pete said, only would apply in a really low value sale situation.
Yeah. Great. Maybe we can go over, Pete, I know you mentioned anti-dilution. We can go over a little bit what anti-dilution is, and two, what are the types of things that you would anticipate seeing, and whether or not that should change based on, from 6 months ago to now.
Yeah. So Geoff, do you want to take this one and I'll jump in after?
Sure. So anti-dilution is basically a protection for an investor against mispricing the investment. And by mispricing, I mean basically paying too high of a valuation. And the way that they figured out they paid too much is that when the next round of investment comes in, and let's say that your round was done at a post money of 10 million, when the next investor comes in and says, hey, we'll give the company another $2 million, but it's at a $7 million valuation. At that point, the investor who put the money in before is not happy. They think they overpaid, and they want an adjustment. And in the old days, or let's say in the last 10 years, it would be what's called a weighted average anti-dilution adjustment. And a weighted average adjustment basically takes into account both the amount of money that's being raised in the new round and the valuation at which it's being raised. And it runs it through a formula. And if any of you are familiar, the National Venture Capital Association, or NVCA, has a set of model documents, which you can find at nvca.org. And those model documents show the formula. But effectively, what ends up happening is if you have a minor reduction in valuation and you don't raise too much money, you'll get an incremental adjustment on the valuation, and it won't have a huge impact. But if you raise a lot of money at a really low valuation, then it will have a big impact. So effectively, that's the most common. Weighted average is the most common type of adjustment. But what I think we're going to start seeing is what's called full ratchet anti-dilution. And as the name implies, it's a big adjustment. It's way more than a weighted average adjustment would typically yield an adjustment. And what ends up happening in that case is if you raised money at a 10 million pre-money valuation, and then you raise even one more dollar in a future round at a $5 million valuation, and just keeping the math simple, the investors who paid 10 million are now going to have the number of shares that they got as converted double, because they're basically going to claw back every penny of overpayment that they had, and they're going to end up with effectively, on an as converted basis, twice as many shares. They'll still have the same aggregate liquidation preference. It just will be that they'll adjust so that they own more of the company. So that's it. This topic can get kind of complicated, and there is a great explanation of it in the NVCA documents if you look at the footnotes there around anti-dilution. But that's kind of the high level. Pete, Craig, anything else?
I think. Sorry, go ahead, Pete.
I was just going to add. So sometimes as we head into full ratchet land, you'll also find, and I don't know if you mentioned this, Geoff, because I cut out for a second. You'll find hybrids sometimes where investors will say, all right, give us full ratchet for a year or 18 months, and then we'll go down to weighted average, just as like
Oh, we lost Pete. I was going to say that's a great compromise, right? As Pete said, that's a good compromise, right? Is if you have to give full ratchet, the investors may say, okay, realistically, the company will need to raise more money in 18 months. So if it hasn't, we haven't had a full ratchet event by that time, we will agree to change to weighted average. But Pete, I think you're back.
Yep, I'm back. Okay, sorry.
No. So before we go into kind of, I know, Geoff, you answered about the safe and convertible note thing, but I did want to spend a little bit of time, talking a little bit about priced rounds versus convertible notes, and safes and convertible notes kind of being cousins of each other. I just wanted to ask if there are other particular terms that entrepreneurs should be looking out for, other than, in addition to what we've talked about, so, sort of specific things that they should be aware of?
Pete, maybe I'll take it first. And so I
Sure.
answered a question and without realizing that it would make the question go away. So someone had asked, what's the difference between a safe and a convertible note? And and my answer was, for those who saw it in the comments, it's maybe there in the answer section. The safe is really it's a construct, contractual document that in essence is very much like a convertible note, except a convertible promissory note is actually debt. And so accountants will argue about how you treat a safe, but a safe really is a contractual agreement to convert, an investment into preferred equity at a later stage, and a convertible note is the same thing, but the convertible note definitely sits as debt on your balance sheet, and if things blow up, the convertible debt has some priorities in a liquidation that probably the safes do not. But I would say they're both widely accepted instruments by investors today, and so Craig, thanks for bringing this back up. And I think whoever asked the question, it's a good question, because at the end of the day, I think we will see a lot of seed rounds that before might have been done as Series Seed preferred, going to either bridge notes or safes. And many of you who have done these in the past, like 5 years, have seen lots and lots of safes being done. And the reason to do a safe or a convertible round is, to kind of steal like a phrase from Wall Street, valuing a company today is like catching a falling knife, right? If you were to look, back a month and a half ago when the stock market was in free fall, you don't know where you're going to catch it and how burned or cut you're going to get by it. And so the benefit of a convertible vehicle, a convertible note or a safe, is that no one's pricing the company. You're basically saying, look, we're going to give you some money, and if you raise a round in the future that meets these parameters, then we will convert into that round at the price that somebody else in a more stable environment has negotiated with you that represents really fair market value for your company. And you will still probably see things in there like conversion caps, which are a cap on what that price can be. And we probably won't go into that here because it's too complicated, but but you'll still see that stuff. But basically the benefit of doing a convertible round right now versus a price round is everyone can sit on the sidelines and see how things turn out. And in essence, it does give the investors, though, like the equivalent of a ratchet protection, in that they're not buying equity today. So they're going to get the price that you ultimately negotiate later when you've demonstrated more proof points for your business and have gotten a VC or a seed fund to write a term sheet for a true preferred stock round.
Yeah, and two quick things on that. One is that SAFE stands for Simple Agreement for Future Equity, which is why it is exactly what its acronym stands for. And two, just a quick question on convertible notes versus price rounds is that you can, clarifying that, is it true that if you open a convertible note, it means that you can sort of take in investors as they are ready to commit to you and get and sort of enable you to get that sort of cash flow into your company bank account more quickly and easily? I feel like people ask that a lot.
So one point I wanted to make about the and then I'll round into your point about the note versus safe as well, is a safe is essentially like a note without the interest or the maturity date. So in good times they're good to have, because in the past we've seen people do convertible notes, accrue interest, and then 12 or 18 months goes by and the company hasn't done the qualified financing, and now you're back to talking to those folks about extending the notes. So safes kind of line everybody up, give them a discount or a cap, but you don't have the interest accrual piece, and you don't have the maturity date, so it's sometimes easier. In terms of what you're talking about, Craig, in terms of having like a rolling closing on notes or safes, it depends. It depends on who your investor base is, how you're moving forward, and there's a lot of nuances to it, right? Like what you don't want to have is 10 convertible notes out. You've done them all as one-offs. I mean, you can, but you've done them all as one-offs and not kind of as part of an aggregate. And then you want to amend something, and now you have to go to 10 separate people to get them all to consent. So, sometimes we'll do rolling deals, but in the notes or the safes, we'll say this is one of a series of notes or safes in the total amount of X. So that if I, so that if I put 50 grand in and I understand I'm part of a $500,000 round, when you go to amend things, I won't have the view that somehow you needed to come to me and we have to horse trade for me to give you something. So I think it depends. That's another one that I wouldn't just take a note form. So I've had people who've taken note forms and have gone out and just sprinkled them all over and came in to engage us, and they have 20 something notes out for 10 grand, 5 grand, 15 grand. Sometimes the terms will change a little. That can create, although it sounds good, it can create an impossibly troubling problem when you try to convert all that in or just figure out what it means and how you round those people up. So before anybody downloads a safe or a note and just starts throwing it around, again, I would say talk to your counsel so you can set up the sequence right, and you can set up how the round will look correctly. So it'll cause you much less heartache when you're doing a round that you're trying to convert all these in.
But on that point, I think, and Craig, it's a great question, because I think as Pete said, rolling closes can be really good for companies, because in this environment, if you can get a check, I would take it, right? That check may not be there in 2 weeks, so get it while you can. But yes, set it up in a way that you create what we would call the majority rule structure, where you have to go back to a critical mass of the dollars in the round, because we have all seen too many of these deals where you have one small $25,000, $50,000 investor who's basically really trying to railroad the management team or the founders and trying to control the process or extract something, get their money back. And it's really a recipe for, honestly, it's a recipe for disaster, but it's also a recipe for running up your costs. And as much as we getting paid, it's a waste of money to have to negotiate with some of these folks. You can spend $10,000, $15,000 trying to buy out an early investor who put in 25K, and that's just not good use of capital for any startup. And so as Pete said, it's easily avoided if you set up a majority rule structure from the beginning and just take the time to do that. So
it's a great point. So maybe I'll go to some of the Q&A stuff that I'm seeing here, and I'll just kind of verbalize it out loud. I see one good question that I may just alter a tiny little bit, which is, to what extent do these terms generally remain consistent from one round to the next versus being renegotiated? So maybe I would ask it that way, but also if we have companies that are either A, have raised in the past and have investors renegotiating, or having terms be renegotiated, a la liquidation preferences and things like that. What is the feasibility, A, and B, how often do you see these types of terms being renegotiated in subsequent rounds?
So my perspective is once the horse has left the barn, the horse has left the barn. And look, can you go back and try to have a subsequent investor come in and change the terms? Like if you did a Series C and you had full ratchet and a new investor comes in, can they say, landscape looks different, risk profile looks different, we're going to do weighted average anti-dilution, and because we're doing it, everybody down the road needs to do it, before us? Yeah, you can, but typically, and there's more nuanced things. There's, things like redemption or, protective provisions may become more granular in this environment. And there's things that, look, if you got to get the money in, you have to do the deal, right? But there's things that you generally don't want to give up because you should view your first deal as your precedent for all your deals. It's not to say you can't go back and try to change something, but once something's given up, it can sometimes be a little difficult to get rid of it.
Yeah, I would say to that, I agree with Pete. I think it's a little bit of a one-way street. When the onerous, tough terms are in, it's hard to get rid of full ratchet and go to weighted average because the next investor coming in doesn't want to get a worse deal when they're writing a new check. But the reverse is true. Like today, almost every deal has weighted average, right? But the new term sheets that are being written, they are being modified to add in these terms. And we just had one where the investors have been in for 3 rounds and they just added a 2x liquidation preference. So it happens, right? It was a it was non-participating preferred with no multiple, and now it's going to be a big multiple. And I think the only way that you get rid of these terms, it probably doesn't happen if you do it in a seed round or an A round. It doesn't happen until later. It might happen in the C round or D round in a category of companies that have what I would phrase way overperformed, right? If you have a super hot company and you're getting 2, 3, 4 term sheets for your, Series C or D round, then it's like selling your house, right? If you get a bunch of offers for your house, magic can happen. If you get a bunch of offers for your company, you now have leverage to go back and say, look, you're good on valuation, but we want to get rid of this, this, and this. And, the existing investors are willing to, give up their multiple liquidation preference or their full ratchet. And so you can try to have things aligned, but in reality, as Pete said, once the horse is out of the barn, it's out, and it's hard to kind of get it back in and take control. But it can happen, and it does happen, but it takes a while, and you have to have a really good company, a hot company for that to really happen. So. Yeah,
that makes sense. And so I see another question here just on specific terms. I know we talked a little bit about some of the more consequential ones like anti-dilution and liquidation preference. But one that founders always seem to come to is information rights, and versus giving the information rights to your angel investor who put in $5,000 or $10,000 to your Series A investor. In these sort of scenarios, do you see information rights changing at all? I don't think we need to have a long answer here, but is there a different world there?
So my perspective is I feel like you could put a major investor threshold into the company's deal docs, which then has you just giving information rights out to the major investors. But what I will tell you, going back to what we just said, if your first Series C deal gives it to everybody, you're going to have a hard time going back and saying, now we're cutting all of you out. I mean, you could maybe do it if you had a threshold of people who could get you there. But politically, it's a difficult sell to people you've already given it to.
Mm-hmm. And I personally am not generally that concerned with information rights for one reason. I know founders can get concerned about this because they're giving up stuff, but the reality is for a Delaware company, Delaware companies have a duty under Delaware law to provide access to information to shareholders who request it. And there is kind of a crazy procedure to really do that. And we only see it happen, like I can think of maybe 3 or 4 situations in the last 20 years where someone's followed the Delaware procedure. But people have a right, who are investors, to ask for information. And, a lot of times you can handle this, but I would not expect information rights other than adding, as Pete said, major investor thresholds or removing them depending on the leverage. I wouldn't expect to see a fundamental shift in this area.
Yeah, me neither.
I think that makes a lot of sense. So as we're kind of getting closer in on time, I just wanted to turn it to you guys really quickly to see if you guys had any, particular final thoughts on in general, term sheets in a recessionary environment, and then we'll kind of close up and I'll sort of point out a few different, and if you have some resources that you could potentially point everyone here to that they could utilize, I think that'd be really helpful.
Sure. I think my kind of wrap up is, I know we spoke about a couple of the kind of hard economic impact pieces, but there's other things that you're going to see, in protective provisions for the preferred or a preferred director protective provision. You're going to start to probably see more kind of more places where they look for, where investors look for protections to kind of make sure that no investor's really going to proactively try to manage or control the company, but they're going to be more concerned about protecting their economic rights. So you may see, those types of rights along with a redemption right, which we didn't talk about, but you can see it in the MVCA forms, and it's rarely used. It's a mechanism for a exit discussion 3 to 5 years from the investment. But it's stuff like that. There's a lot of nuance that you're going to see. So to me, again, not to beat a dead horse, I don't know why I'm using horses so much today, but not to beat a dead horse, but I think as soon as you get the term sheet, get it to your counsel so they can work with you through it, because your attorneys have seen tons of these. You know, I can get a term sheet and look through it probably in a half hour and be able to highlight everything that's different from what has been customary over the last decade. So it should be, you know, I would tell you the net of this is go to your counsel early as soon as you get the term sheet. Make sure they're looking at it, and they'll help you through kind of all of this nuanced discussion, not just the larger economic decisions.
Yeah. And then, yeah, I think a couple resources. Someone in the comments had mentioned the Brad Feld book. So Brad is a, you know, longtime investor at Foundry Group, and before that was at SoftBank. So his book is very, very good. It really helps entrepreneurs understand what they're doing. And I think going back to something you said earlier, when you're as a founder looking at a term sheet, you may have looked at anywhere between 0 or 5 prior found term sheets, depending on whether it's your first company or not. But the VCs on the other side of the table have looked at between, you know, 50 and 500. And so there's a real asymmetric knowledge base. And so, you know, reading something like Brad Feld's book is a great way to sort of understand not only some of the terms that are in there, but sort of the psychology from the investor's perspective. So that's definitely recommended. There are also a lot of good blogs out there, and you can find a lot of them, like Fred Wilson's blog and a bunch of others that are, some of which have restarted. I think Fred's restarted recently. So there's a lot of good resources. I think there were a few other comments that we didn't get to, but I think, you know, these situations are fluid. And, you know, one of the questions was, are there tranche deals? And 100% we will be seeing milestone driven tranche deals, which have always been very common in life sciences, but are less common in tech. The only time they're common in tech are markets like this one, where investors say, look, we're going to put in 5 million, but only 2.5 is going in up front. And the next 1.5 is subject to these milestones, and the next 1 is subject to these milestones. And those are fungible, and investors will waive them often if you don't hit the hard targets. But they're a way to kind of keep management teams on a shorter leash, because the investors just don't know what's going to happen. So I would just say expect things to be fluid. And, you know, when you see a term sheet, and it will jump out at you when there's stuff in there that doesn't seem normal, but you know, just be prepared to expect the unexpected, and have to actually negotiate these term sheets a little bit more than you did in the last 5 years, where a lot of the negotiations were around, like, how much control do the founders keep, and what can the founders sort of protect, and what's the valuation. Now there are going to be stickier issues that have longer term and bigger implications. So it is what it is, but you will get through this. And, you know, just your co-founders in prior downturns have done really well as well. It's, you know, it's a more involved process.
Yeah, I agree with all that. And my one resources that I think Orrick has great resources. They have a term sheet generator on their website, I believe. As we mentioned, Y Combinator has excellent term sheet and fundraising resources that I encourage people to check out. The Venture Deals book by Brad Feld is also excellent. What I would also encourage people to do is not be afraid to ask questions about specific terms, and you can ask why. And if the answer that you get is because that's the way it's done, that's not a satisfactory answer. I think you're allowed to ask why and get a reasonable answer as to why a particular term is done the way that it's done. So don't be afraid to ask as many questions, and please lean on your counsel. With that, I want to thank Geoff and Pete for doing this for an hour. Thank you guys so much. And for all of you on the webinar, this is the first of 3 events in our new normal series with Orrick. So next week and the week after, we have employment and managing employment in a recessionary environment, and M&A in a recessionary environment the week after, which is mergers, acquisitions, and everything that has to do with that. So thank you all for coming. Stay safe, stay sane, and stay healthy.